Today's currency report, more evidence of blue skies ahead for the world economy, giving a lift to those riskier currencies like the euro and hitting the safe haven dollar and yen. But the show stealer will be tomorrow's jobs data. Lien has published many reports studying the foreign exchange trade surrounding the release of non-farm payrolls. She's the head of research for GFT, an online foreign exchange broker. Kathy, good to see you again. Thanks.
Good to see you.
The survey that we have of the economists showing that they expect payrolls to fall by 365,000 for last month. What's your expectation?
I think the number will be higher. I think you're going to see non-farm payrolls probably fall between the 375 to 450 range. But if you take a look at the leading indicators for non-farm payrolls, and usually there's 10 of them, but because service sector ISM is being released afterwards, it really tells us that we could see a pickup in job losses because the monster employment index actually deteriorated. We also had ADP this morning report, larger job losses.
But ADP not always so reliable. We had an earlier guest kind of remind us of that.
You know what's really interesting? I was looking at these numbers this morning. ADP is not so reliable in the initial release, but if you actually compare ADP with the revised non-farm payrolls, that the numbers are actually closer. But that won't matter as much for tomorrow's trading. But ADP is not so accurate in terms of the absolute numbers for the initial release, but directionally it is. So the ADP number is pretty much around the previous number. And usually ADP tends to undershoot payrolls, and so that really suggests that we could definitely see undershoot the losses in payrolls. So that tells us that we could definitely see more of a larger decline in payrolls in the month of June.
ADP is a lagging indicator?
ADP is a lagging indicator for the headline release, but really, people don't pay too much attention to the revisions. But if you compare the revisions to the actual numbers, that they're actually, pretty close.
When it comes to the currency market, though, and those non-farm payroll numbers, it's really kind of a volatile piece of data when it comes to currency trading, isn't it?
It is a tremendously volatile piece of data because not only do you have to deal with the headline release, but you have to deal with the revisions, you have to deal with the whisper number, and you have to deal with revisions to the birth-death model if there's any. So typically, I took a look at the price action of the euro-dollar right after non-farm payrolls.
And I think we actually have the chart. Let's bring it up for our viewers.
And what I've seen is that 6 out of the last 6 times that non-farm payrolls was released, the knee-jerk reaction rarely is the real one. What tends to happen is that we see a knee-jerk reaction on the dollar, on the euro-dollar, and then that is reversed, and that becomes the primary move for the rest of the day.
Help me out here. So what are we seeing here? This is a chart showing euro-dollar. It's highlighting those non-farm payroll releases in the last 6 months. So that's kind of showing the volatility surrounding the report because you can kind of see some of the peaks and troughs that have been hit on the day of the actual report.
Right. I mean, basically here we have a little bit of a longer-term chart in the euro-dollar. So it masks a lot of the intraday volatility. But, quite honestly, 6 out of the last 6 times, you'll see the euro-dollar, typically move in one direction. Because what happens is that, for example, if we have a weak non-farm payrolls number tomorrow, what you'll probably see is a euro-dollar rally initially, because you'll have the people selling dollars because of the weak release. But then what you tend to see is maybe the dollar gains strength and the euro-dollar continue lower because of risk aversion flows.
This is my problem with the dollar. I mean, if it's a weak report, people often go to the dollar as a safe haven.
Right.
If it's a weak report as well, there's concerns about the economy, lower interest rates, which isn't good for the dollar. So how do you make sense of it?
And that's the predicament that we have right now. What you have to recognize is what is the driving force in the markets right now. Right now, the driving force is that things are getting a little bit more optimistic, and so people are still looking at the dollar as a measure of risk. So therefore, that, even though fundamentals are important, and if non-farm payrolls is weak, it should mean, a weaker dollar. What matters right now is the dollar's trading off of risk appetite. So the key is, if we have a good number, that the dollar should actually, weaken throughout the course of the day, even though the knee-jerk reaction may be dollar strength.
And Kathy, you mentioned that improvement in last month's non-farm payrolls number was rather sharp. Can that be sustained?
I actually think that what you'll probably see is a dip in non-farm payrolls, meaning that we'll actually see a decline. Because I took a look at how non-farm payrolls was back in the 1980s. And what we saw then is on the path back towards positive job growth, we had some hiccups along the way, meaning that, non-farm payrolls got better better. We had less job losses, but there were months where they actually sort of retrenched. And so I think this will be one of those months.
We're also seeing continuing claims come down, correct?
A bit. I mean, the latest continuing claims report actually increased. We had that one flu.
Weekly jobless, I should say, yeah.
Yes, weekly jobless claims are actually improving. But we're still above the 600,000 level, which is a psychological point.
And Kathy, we're going to have to leave it there. Kathy, thanks so much for coming in. Kathy Lien, Director of Currency Research for GFT. And you can find all the latest currency numbers and stories on our website at Bloomberg.com.